There is a big difference between time in the market and timing the market. When starting out, the simplest thing to do is spend time in the market as opposed to trying to time the market, which is much more difficult. But what I wanted to talk to you about today is you need to be good at diversification. Now, diversification is so important and a very simple concept. The more you diversify your money into different investments, i.e. spreading your money not just in one, but several asset classes, the less that one single event, no matter what it might be, such as a crash in one sector, can hurt your finances. And that is why financial advisors, professional investors, they talk so much about asset allocation, i.e. how much money goes into which asset or investment. Now, I realize this might not be the most exciting of topics, but it is an important topic and one worth paying attention to. An asset can be property, stocks, cryptocurrencies, precious metals, commodities, collectibles, cash. I'm sure you can think of some more like bonds, something that I would never do, but anyway. What some people don't realize is that you can even diversify within one asset class. So for example, in cryptocurrencies, we teach you how to invest over the long term, as well as trade in the short term. Also staking to get free dividends of anywhere between 6 to 20% a year on your investments just for holding and not selling. Then there's ICOs, initial coin offerings, and investing in public companies on the stock exchange that are taking advantage of blockchain technology. So can you see that within that same asset class, cryptos, can you see how we can diversify our money into 5 different ways of making money? So you can have diversification even within one asset class. And of course, if you're younger, it's likely that you have a high appetite for risk. So you might lean more towards stocks, crypto, startups. If you're a little bit older, then maybe a little bit less open to risk. So maybe real estate, or you want to be in cash, etc. Of course, I'm generalizing. Everybody is different depending on their character, risk appetite, time horizon, and other things. So without going into too much detail, what's important is that you don't put all your eggs into one basket and that you diversify your investments. Here's another example. Within stocks, just going into different stocks and they happen to be in the same industry or sector, that's not diversifying. But if you have one stock taking advantage of AI, artificial intelligence, another one manufacturing, another one clean energy, another one 5G, and you have different strategies, you will be diversified. By the way, you can also use different time frames to diversify. Some can be more long-term, others short-term. Give you an example. We hold Bitcoin for the long term, but if we see weakness and we believe it's going to go down in the short term, we will sell it short. So can you see we're long Bitcoin on the one hand, on the long term, short Bitcoin on the other hand, in the very short term. Another way of explaining it is using the analogy of sports. In any game, whether it's football or basketball, there is an offensive and a defensive play. Now, offensive might be crypto or pre-IPO shares, biotech, etc. And defensive might be gold, silver, commodities, cash, property, etc. Look, whatever happens, just ensure you do diversify. Avoid the mistake of putting all your eggs into one basket. And if you do that, at least ensure that within that basket, you are diversified as much as possible.